I now hand the conference over to Mr. Anshuman Deb from ICICI Securities. Thank you, and over to you, sir.
Thanks, Rayo. Good evening, ladies and gentlemen. It's an honor and great privilege to host Nippon Life India Asset Management Limited earnings conference call for Q1FY22. I now hand over the call to Mr. Sandeep Sikka, ED and CEO. Over to you, sir.
Thanks, Nippon. Good evening and welcome to our Q1 FY22 earnings conference call. We have with us Prateek Jain, Chief Financial Officer, Sugata Chatterjee, Co-Chief Business Officer, Ashwin Dugal, Co-Chief Business Officer, Arpan Saha, Chief Digital Officer, Fujitake-san, nominee from Nippon Life Japan. Overall, industry assets continue the positive momentum in the quarter driven by higher equity and ETF assets. The increased participation by individual investors indicate confidence by long-term investors in mutual funds. We expect the industry to maintain its growth trajectory over the next 3 to 5 years. At Nippon India Mutual Fund, our priority is to be future ready and capture the long-term opportunity. I'm happy to share Nippon India Mutual Fund Q1 market share rose by 13 basis points to 7.25%. AUM increased by 33% to 2,404 billion rupees. We increased our share of industry's unique investors to 31% with addition of 6 lakh unique investors as compared to 11 lakh for the industry. Improved short and medium-term fund performance has had a favorable impact on the asset flows and disproportionately higher accretion in investor base. We have one of the largest retail AUM in the industry at rupees 696 billion. The contribution of retail AUM to total AUM is amongst the highest in the industry at 28% compared to 23% for the industry. We are amongst the market leaders in beyond 30 cities category. This category contributes AUM of rupees 472 billion. 19% of the total assets are sourced from these locations against an industry average of 16%. As on June 30th, 2021, 69% of the individual assets have a vintage of more than 12 months. The annualized systematic transaction book is at rupees 70 billion. On a gross basis, systematic folios rose by more than 314,000 in Q1. The new digital SIP registrations grew by 59%. In volatile markets, folios with lower ticket size have demonstrated longer vintage and better stickiness. Today, Nippon India Mutual Fund offers the industry's best suits of passive category. With strong growth in industry's passive assets, our ETF ecosystem is already in place and far ahead of peers in terms of investor base and mindshare. In this segment, we manage AUM of rupees 402 billion and have a market share of 13%. Excluding EPFO allocations which go to 2 PSU-owned mutual funds, we would be the largest ETF player in the country. The gold ETF is the biggest in the category with over rupees 60 billion in assets. Nippon India Mutual Fund share in industry's ETF folios rose to 51%. In Q1, we added 1.4 million investors against a similar addition in the previous financial year. Nippon India Mutual Fund additions represent 82% of the total folios added by the industry in Q1. Nippon India Mutual Fund has 73% share of ETF volumes on NSE and BSE stock exchanges. Our ETFs average daily volume across key funds are far higher than rest of the industry. As a well-diversified asset management company, we have created our presence in new business segment over the years. Along with government mandates, we manage assets of 1.3 trillion in non-mutual fund segment. The offshore business has assets of rupees 101 billion under management and advisory. Leveraging Nippon Life global network, we continue to ramp up our international presence. As part of collaboration with Cathay Site in Taiwan, we have already filed Taiwan Equity Fund for regulatory approvals. The fund will provide Indian investments access to dynamic and growth-oriented Taiwanese market. We will continue to offer domestic and foreign investors more value-accretive avenues to diversify risk and generate returns. In our AIF business, we manage Category 2 and Category 3 AIFs across various asset classes. Nippon India Digital Innovation Fund has committed funds of $100 million and has initiated investment activities. As on June 2021, Nippon India AIF raised commitments of rupees 38 billion across all funds. Online and digital assets have become a key source for investor acquisition and communication. Nippon India Mutual Fund's digital business has grown at a rapid pace, driven by robust strategy encompassing sharp business focus, relentless partner engagement, and innovative transformation endeavors. Our strong digital acquisition and engagement framework with targeted performance-oriented campaigns is driven through cutting-edge tools like Adobe Campaign Manager. These initiatives have helped fuel consistent growth in our storefront and in various other conclaves. Our strong collaboration, backed by years of fund management experience, help us to cement our position as a partner of choice for distributors. Our focus on perpetual innovation and persistent digital re-engineering has ensured that a digital experience is always friendly, futuristic, and frictionless for its partners and investors. With an inherent DNA to consistently pivot and innovate in diverse digital ecosystem, we aspire to learn, invent, and grow and stay ahead of the curve in the BFSI space. In Q1, digital platform contributed to 58% of our new purchase transactions. Approximately 600,000 purchases were executed through digital assets, an increase of 28%. Nippon India Mutual Fund has well diversified and nimble distribution base. As on June 2021, we have approximately 80,000 distributors empaneled with us. The MFD base rose to over 79,700. Also, we have ongoing tie-ups with over 20 prominent digital partners. Digital channel contributed 55% of the MF AUM. Of the distributed assets, share of MFD was 58%. 83% of the distributed assets are contributed by individual investors. Nippon India Mutual Fund has a strong presence through approximately 280 locations across the country. We continue to review our existing branch network and future branch expansion. Given the new normal, our marketing efforts are increasingly focused more on digital channels, which are cost-effective as against offline advertising. Now on our financial performance. For the quarter ended June 30th, 2021, profit after tax was rupees 1.8 billion, an increase of 16%. Operating profit increased by 75% to rupees 1.7 billion. Operating profit as a ratio of average assets under management rose from 21 basis point in Q1 FY21 to 28 basis point in Q1 FY22. Our aim is to create sustainable value through growth across asset classes, cost optimization initiatives, resulting in an expanding and favorable operating leverage. We continue to grow organically through our physical and online channels. Additionally, we remain open to evaluate investments in strategic opportunities that add to the profitability and complement our existing businesses. In June, we took a very important step in our journey towards becoming a responsible corporate citizen. NAM India became a signatory to UNPRI, world's largest voluntary corporate sustainability initiative. We are in process of incorporating UNPRI's ESG principles across all facets of business, including investment management, climate conservation, and social contribution. We will continue to enhance capabilities towards successful execution of a stewardship responsibility and give voice to minority investors. Also, with integration of formal ESG principles into NAM India's investment management framework, we also look forward to launch new ESG integrated offerings in near term. To sum up, I would like to reiterate, at NAM India, investor centricity remains a key theme. We strive to deliver a complete product suite to the investors, superior fund performance, efficient client servicing based on a comprehensive digital ecosystem. We are confident to continue our trend of profitable growth in coming quarters. With these comments, we are happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj from Securities Investment Management. Please go ahead.
Hello.
Yeah, Viraj.
Hello. Yeah, hi. Thanks for the opportunity. Just have 4 specific questions. First is on the yield. If I adjust for the mix impact in AUM, have you taken some cut in TER in either equity or debt? Because the drop in yield sequentially is higher even if I adjust for the mix. So, any perspective you can share, and incrementally, how should I look at yield moving forward? So that's one.
So what is the second question? You want to continue with all the questions, then we can...
Yeah. Second is, so despite the jump in the AUMs, our cost base has largely been flat year on year. So have we restrained from A&P spends in the quarter, and incrementally we should see this moving up for us? Because, if I look at FY21, the major drivers between lower OPEX was cut in A&P and travel and convenience, while IT expenses had moved quite sharply for us. So just want to understand the cost part. Third is largely on the distribution and the market share. So, if I look at our overall mix in terms of source of distribution by AUM between, say, retail, bank and national distributors and, direct and all, the share of bank and national distributors has been, relatively weak for us. And that has not really picked up despite, us seeing some improvement in our overall performance. So just want to see how is the overall market share for us move for us in, say, equity, debt in T30 cities. And a related question is, same has been for the SIP flows. For the industry, we are seeing a pickup, but for us, it's still relatively subdued. So, any perspective you can share that. And last was on the NPS business. Any thoughts of re-entering, because PFRDA has made changes to yield, is looking at a wider participation in terms of competition in the space. So, yeah, thank you.
Yeah. So, Viraj, this is Prateek here. So, see, I'll take, questions as you've asked. So, in terms of, market share, we continue to be leader in our retail segment. That has been our forte. And, almost in terms of the overall, if you see the breakup, 55% of our, AUM assets comes directly. Out of the 45% which is distributed, 60% comes from mutual fund or the MFDs, and 21% from bank and 21% from ND. This is, again, if you look at the other composition, which is the retail versus the HNI segment, while, our share of retail is about 28% as compared to the industry of 23%, we have been, because of the erstwhile issues, we have been lower market share on the HNI sector, which is predominantly supported by the banks. So this is, one, by design, we have been focusing on B30 cities, working closely with the distributors to to maintain our profitability and to grow our business more profitably. So that is one reason. And secondly, our share of HNI has been lower, and which is also resulting in lower share from the banks distributors. That was one. Secondly, in terms of B30 cities, I think, we have a market share of about, or our AUM composition, 19% comes from B30 cities, which is healthier as compared to the industry of 16%. As regards the SIP flows, this has been marginally subdued, and we have seen some decline. We had not so good run in terms of our performance, but in the recent times, our performance has been good. Most of our schemes have been, in quartile 1 and 2, and generally we see the flows coming in after a lag. So we are expected to do better, going forward in terms of the SIP flows. As far as the cost base is concerned, we have mentioned that we'll keep working towards improving our operating efficiencies, and we have mentioned that, with the AUM growth, the expense will not grow in the same linear proportion, and that is where the operating leverage will come in play. However, as you rightly said, that partial decline can also be attributed towards the lower mobility, expenses, etc. But if you look at the last 16 odd quarters, we have been maintaining lower cost to income ratios, and we've been trying to manage our costs better. So we'll continue to do so. And also, let's say if the assets grow double from here, we do not see a significant increase in our expenses, because most of the expenses are fixed in nature. Coming to the last yield part of it, I would say that, basically the yield, the net profit yield or PAT to AUM is composition of 3 or 4 factors, and importantly, it will all depends on how the asset mix is, how within the asset class, how the product mix has been changing. We have maintained that in terms of the fixed income also, the most of the money has been coming on the ultra short term and the low duration funds, where our realization is marginally lower. Further, in terms of increase in size of the assets of equity, that also bring down, the realization. And again, there are other 2 factors, which is the new assets which we are raising. Typically there is no upfront, so they are coming at a higher trailer fees, and the older assets which get replaced, with the new assets, then that again the realization, because of the full trail model, is slightly lower. So these are the 4 or 5 factors, which contribute towards the declining yield. But I think our yield has been broadly flattish. If you see the last 2 or 3 quarters, I think we have clocked about 45 to 46 basis points. I hope I've answered all your questions.
On the PFRDA, NPS business.
Sure.
I think we will continue to keep evaluating it. Last time we had to exit it because there was the constraint of the 49% foreign shareholder, but we remain open to explore going forward.
Okay, just follow up on the market share in T30. So if I look at one of the distributors, like say the wealth management arms or other national distributors in T30, has there been any progress in terms of us, getting, are we able to kind of break in terms of, either getting a product empaneled, or are we seeing any traction there? Because as you said, earlier the performance issue was there, and therefore there was some hesitancy in terms of onboarding our products in the empanelment.
I think we have seen a lot of green shoots. I think the fact that the market share, which has increased in this by 13 basis point, is a subset of all the categories. We clearly see more and more banks empaneling our products across over the last 16 months. We have seen a lot of family offices and new corporate investors joining. So I think numbers will come with a lag effect, but we can see on ground there's a lot of positivity, and you will see going forward all these categories, whether to banks, HNIs, I think with the performance and the brand getting established, you will see the market share going up.
Thank you. Good luck.
Thank you.
Thank you. The next question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Hi, thanks for the opportunity. Hope everybody is doing good, and congratulations on good set of numbers. So broadly, I had 2 questions. One was on the the distribution side. So in the annual report, we have been talking about decision aggregators, and we've seen the phenomena happening in the entire industry, where the incremental assets, especially in the SIP side of the business, the digital aggregators are becoming an important source. Can you, throw some light, how this space has been, evolving in last 1 year in terms of total assets managed by these digital aggregators? And as ma'am, how much you had mentioned in your opening remarks that we work with 20 such aggregate like digital partners. How much of our AUM, like incremental AUM, would be coming, through these, or digital aggregators, and what would be the unit economics there, like with the AMCs? Because what we understand is that they don't charge to the customers. How, can you throw some light on the entire value chain in that space?
I think I'm going to be requesting my colleague Arpan, the Chief Digital Officer, to be talking a lot about it. But I think before that, I will just say slide number 13, 14, and 14 to 17 gives a lot of details about our digital initiatives. I think we clearly see for ourselves as a company playing an important role, both I think with the digital aggregators, I think whom we see will complement our growth, and also the offline business. So from our perspective, both the channels will throw big opportunity in times to come. I think we as an organization are taking both the channels very seriously. We are not in the camp who believe that it is going to be one versus the other. We believe over the next 10-15 years, taking into account the 2% penetration that we have, both the channels, online and offline, will play a very big role. But specific questions on digital, I think, Arpan, if you could add some data points on it, please.
Sure. Thank you, Kunal, for your questions. At Nippon, we've always believed, that a great digital story comes out from a great digital ecosystem. So for us, our left hand and right hand, are firmly embedded in the digital chassis, where fintechs and RIAs as an aggregator community are a part of it. And therefore, as Sandeep was pointing out, we have a great equitable focus on all digital facets. Now, coming specifically to the digital, distributors or aggregators in place, let me tell you that, in the last financial year, digital, partners in the non-liquid space, and I'm going to talk about the non-liquid space, grew by 200%, while we, as digital business from Nippon across RIAs, grew by 270%. Now, this comes because of our ability to understand where people who invest in Nippon India Mutual Fund products would look across common platforms and invest accordingly. And therefore, there's a lot of tech knowledge, know-how, and share that we do with our partners to ensure that the consumer's journey is, again, on the 3F principle, which is friendly, futuristic, and frictionless. Even on the SIP piece, as we had pointed out, digital SIP registrations contribution was around 59%, and we grew by a quarter-on-quarter growth of 34%. This is our inherent ability to educate our set of investors when they're across the internet space to understand the importance of doing an SIP and the real importance of doing one with Nippon India Mutual Fund. We are a very progressive company, and our focus has always been on the millennials. So I think aggregator space is just a platform where the right-minded people come in to get the right product, which is of Nippon India Mutual Fund. That's all from my side.
So Kunal will be happy to take any questions specifically in detail offline on this, but digital remains a very important focus area for us. And as I mentioned in my opening comments, 20 integrated partners, I think are the significant ones, and there are a lot more work is happening. We continue working with our strategic partners, which is IBM and Adobe, to strengthen our digital business.
Sure. I'll get back on offline to understand more about it. Thanks for that. The second question was on on the market share in the equity side. As you mentioned, as Prateek mentioned in his remarks, that we have seen the improvement, and there's a lag generally when the flows come back. Now, if you look at both the SIP market share and the equity market share, it has been trending down even on the improved performance, which of course shows that our flows have been slower than the industry. Now, just wanted a sense, are we still, looking at outflows, or is it, our inflows are slower than the industry? Any indicative, idea on that would be helpful.
No, so see, Kunal, as I mentioned earlier, that look, we have seen marginal decline in terms of the SIP value as well as in terms of our total, or we have been lagging in terms of the industry growth as compared to our equity. But predominantly, what we have seen is that look, we are coming out of a slightly bad patch when it comes to performance. But when you see today, most of our schemes are in quarter-one and quarter two. Okay, and typically once the performance come back, the investors comes with a kind of a lag, and we are very confident that we will be able to garner higher assets. And just to let you know that, see, we had mentioned in the past that first one to come will be the fixed income assets. So this quarter, I can share with you that look, while industry was negative 1,500 crores, and we have added almost about 4,000 odd crore of asset on the fixed income side alone, X of liquid. So I think it is a function of performance and also the confidence coming back. And on the institutional side also, we have seen as Sandeep was mentioning in the con call, the good amount of flows when it comes to the direct investor into our ETFs or institutional investors coming on our ETF and the fixed income side. We are sure with performance back, I think we'll be able to resurrect or gain back our lost market share on the equities. But at the same time, I want to share that on YOY basis, our SIP folios are up 10%. So on the folio side, we are, or incremental addition side, we are doing well, but it is the lower ticket size and also the HNI share which we are lagging. I think that needs to be, worked upon.
Sure, I get it. Thanks for the detailed explanation, Prateek. All the very best to the team.
Kunal, this is Saugata Chatterjee this side. Just to add to what Prateek and Sandeep has mentioned, I think on the equity side, it always comes with a lag. So in terms of SIPs, our incremental SIP numbers have started increasing. The SIP book is an aggregate of the monthly SIP accretion which keeps happening. So as we go ahead quarter on quarter, in the last 3 to 6 months, what incremental new SIPs have come to us, it will start adding to the SIP volumes. Likewise, the similar trends we are seeing in equity from a lump sum perspective, the net sales have started now moving into positive zone. So we are flattish. So that is the trend line we'll see going forward. Once the base is getting created, now on top of that, the incremental sales will start adding market share for us.
Sure, I get it. Thanks a lot for this. Yeah.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Anush Kumar from B&K Securities. Please go ahead.
Hello. Thanks for the opportunity, sir. My question is on the other income side. Why did the other income not move further despite decent moves in debt and equity markets in Q1FY22?
No, so we have almost about 61 crores of other income as compared to 55 crores last year or last quarter. I'm saying sequential quarter. See, the corresponding quarter of April to June, if you see, there was a sharp reversal because the market fell on 16th and 23rd of March respectively in 2020 because of the COVID-related lockdown. But in the first quarter, it bounced back. The first bounce back happened, and that significant bounce back has led to a mark-to-market gain. There was a 100 crore mark-to-market loss, if you recollect, we booked in the fourth quarter. We gained almost the same amount in the first quarter. However, this was more of a, this time around, this has more rationalized. Also, as mentioned in the past, we have pared down our exposure to the equity related mutual fund. So from the last 1 year perspective, we have reduced our exposure to our own equity schemes.
Thank you, sir. Thank you.
Sorry?
Thank you, sir. Thank you.
Thank you. We take the next question from the line of Harshit Toshniwal from Premji Invest. Please go ahead.
Prateek, hi, this is Sandeep. Things are doing well. Am I audible?
Yeah.
Yeah. So few questions are on the market share piece itself. So in terms of folios, we have, when we look at our folio market share, then we are right now 33%, which used to be a 30% market share last quarter. So clearly we have done a great job over there. But I'm just trying to see that, so is it that our market share in B30 is increasing, but our market share in T30, that is something which is remaining weak? And when we look at the HNI category, can you throw some more color on what needs to happen for us to again gain back that market share? Is it the fund performance only which matters, or we need to take some additional steps to regain the market share in the top 30 HNI segment, because of which our overall equity market share is not improving?
So, I think let me, give some initial comments, and I'll request my colleague Ashwin Dugal to also touch upon it. So, I think you're right. I think the new retail folio numbers have been increasing. Have added about 14 lakh investors in the last 12 months, and it continues to increase. And 33% of the industry folios are with us. So, I think that is a good thing. And I have always believed retail execution is always more difficult, and the fact that the retail investors have started coming back, we take it as a very big positive. Now, I think the key lies in, I think the retail investors also have to understand the fact that I think in a bull market going on, a retail investor is someone whose SIP definition is less than 2 lakh rupees, and our own definition is a SIP of 2,400 rupees. That cannot match up with HNIs. So that's the reason many times when you see from the increase in folio does not match up with the market share increase in the same manner. But I think it's a question of it to catch up. Coming to your question on what do we have to do in retail and HNI, I think it's also important to understand, I think within the HNIs also, clearly, I mean, these, as we have seen the increase in market share in fixed income and ETF, it's a matter of time you will see that also happening on the equity active side. The fact remains that while our overall market share for HNI as a company is about 7.5%, for HNI is 5%, but within ETF, HNI market share is 18%. So what happens is...
So the reason I'm saying that because in ETF and fixed income, fund return does not play a big role. So and clearly,
I think the point what I'm trying to say, these are not mutually exclusive. So what will happen is I think investors will keep moving towards different asset classes. We have already touched upon the fact that we are, I think, over the last 2 years, we have implemented a lot of factor analysis and various styles in our fund management work. A lot of proprietary tools from Nippon like Japan have been wherein I think our fund management team has been working very closely with that. And the fund performance also, if you see, most of our schemes are in quartile 1 and 2. I don't want to go individual name by name, but whether you see the top 5 funds that we have in size of AUM, whether it's large cap, mid cap, growth, small cap, all these funds come in the quartile 1 now. So it's a matter of time. The point I was trying to make is when the same investor HNI has started coming, which was not looking us for fixed income, has started coming in fixed income, has started coming in ETFs. It's a matter of time. I think he or she will also start. The family offices will start looking at our active fund management also. So I think the point I'm trying to make is I think we remain happy on one part. The retail, which is more difficult to execute and more stable, that has been going very well. And HNI, directionally we are going in the right direction. Specific your question on equity, it has taken a little more time, but I think the fact that they have come back in ETF and HNI, it's a matter of time they'll come in active also.
Sure. Just one additional follow-up on this. So when it comes to HNI, you think that our relationships with maybe the larger distributors like, for example, IIFL Wealth or the larger bank houses which are there present, do we need to push that a lot for the HNI category? Because possibly they will not be going onto the digital route given the intuitive nature of the asset. And secondly, if launching more new fund offers at this point of time when we have the performance for the last 6 months in favor of us, so launching few new NFOs to gather the market share over there, do you think that can also be an additional approach? And if you are planning anything on that?
So I think I'll take your first question. I think from our perspective, we have a multi-pronged strategy. We continue working with all distributors and advisors, family offices and RIAs, who are the gatekeepers for various family offices and HNIs. And clearly the approach is, I think, to work closely with them, and we have seen initial success. To your question, a lot of these HNIs and family offices, for them, uniqueness of product also plays a very big role. I think from our perspective, we are trying to see wherever there is a vacuum in our portfolio. I think we keep launching new products. But on the last part, will we launch NFOs just for the sake of garnering market share? Answer is no. Our focus remains on profitable growth. We will only launch schemes which we believe have scope in our portfolio and are long-term sustainable and scalable. So let me give you an example. In the last 2 quarters, earlier we launched IT ETF, then we launched basically the pharma ETF. Now we have launched filed with SEBI for Taiwan fund, which will be the first Taiwan fund from India. So I think clearly seeing the shortage of semiconductors in the world, I think we see that as an opportunity. So I think we are trying to, this is a market where it's a market within market, there are micro markets, the approach has to be very different. It is not one push thing. So I think what gives me satisfaction is the team is working in the right direction, and all, whether it's HNI, retail and corporates, they have started coming back. The lead product for them or category could be different, but all of them have started coming back.
Perfect. Great. Thanks a lot for the performance.
Thank you. The next question is from the line of Prayesh Jain from Yes Securities. Please go ahead.
Yeah, good evening, sir. Congratulations on good set of numbers. Firstly, on the yield that you spoke, you gave some qualitative comments as to why it has come down. Could you give some quantitative flavor as well in terms of whether the equity yields would have been down by, say, around 2 or 3 basis points over the past 12 months or something like that? So to know whether that is the quantum that we've seen in the past 12 to 14 months?
No, so, Prayesh, we do not talk about the individual, product, pricing. But, on an overall basis, the yields have been broadly flat. And also, as mentioned to you, that, from our side, having larger proportion of shares coming from mutual fund distributors as against banks and NDs, and also larger amount of money coming from B30, that, and as Sandeep mentioned, that if we are able to raise further assets, you will see, there is, an uptick in terms of the overall realization. Also, we believe that over a period of time, there will be shift in the fixed income side. Today, large part of the money is being, in the asset class, which is the low duration, or ultra short-term category. The moment it starts chasing yields and you move towards the credit and the, higher duration, our propensity to earn, there will improve. Also, I think, what one has to start seeing this business is not from the yield perspective, because what I think, we are missing is, if you see today, let's say, I think there were some industry reports which says that, look, even the industry grow at about 12 to 13%, the industry will be about 3 times the size where we are. And I think that's an understatement, because given the under-penetration and also given the 20% growth in the last 5 years, I think if we continue that kind of a growth pace, then let's say even if we take a conservatively the total assets goes 3 times and our revenue grows, at the same levels become, 3 times, the expenses are not going to be increasing by 25 to 50% because they are largely in the fixed nature. And therefore, you will see 10 basis point improvement in PAT to AUM or PAT to revenue basis. So I think, that is where I think we should see, because the end of the day, the overall growth will come from the growth in the total assets under management, the change in the mix, and also the last bit is the realization.
Got that. Thank you. Now, just extending that point a bit, so the legacy assets versus the newer assets, how much time do you think would continue to impact the company, Nippon AMC?
No, so see, this is, I would say this is ongoing, but that you have to understand that it will keep tapering off. So it's a, kind of a telescopic thing, where it keeps reducing, right? So it's like a railway fare. As the distance grows, the price or the ticket price does not go as much. So today, what we have seen is, the large part of the fluid money, with the banks and NDs and, the money which was to move out has already moved out. And this is the large part is with the smaller investors. And we have seen that these are more sticky. So what we believe is that whatever in terms of the old asset movement was to happen, largely that has happened. And we will not be impacted by that. And as far as the new asset is concerned, it will all depends on our strategy, which is more towards the MFD and the smaller cities and town, and also vis-a-vis the competition, because in the marketplace we have to compete, so what is the competition is giving. So we have to, align our strategy balancing both the sides.
Okay, interesting. Probably on the, when you talk about your distribution strategy, you've been telling about growth in terms of B30 towns and thereabouts. So, what we have understood is that these the customers in this area would search online, but eventually depend a lot on MFDs. So, so from an equity brand standpoint, do you think that we are back to the levels we were, say, possibly 5 years back, where the other brand name was very strong, but now Nippon as a brand is growing up the ranks?
I think if I'll take this one, so broadly, if you were to look at the fact that 14 lakh new investors have been added. Now, if I was to go with the same analogy of they are searching online and these people, 14 lakh investors, 50% of the investors in the industry have been added by Nippon, is a testimony to the fact that both the brand and the execution, both are going in the right direction. So I think it's always going to be it's a journey, and also with the increased better fund performance, and also I think because it was a new brand in India, but the good thing was it was the same old team. So the fact 14 lakh investors for me give me a lot of satisfaction and confidence that I think this base will keep increasing. And from our perspective, we have always believed for us. The business has to be very granular. The long-term stickiness of assets come from smaller investors. So I think we'll continue focusing on more and more retail investors from a long-term point of view, because there's a lot more scope for further top-ups. I think when you get smaller ticket size. So I think to your question, I leave it to you to gauge. 50% of the investors in the last 15 months have been added by Nippon. Both the brand and the execution are going in the right direction.
Just a last question. Any outlook that you would like to share on the foreign funds that we are planning to increase?
Nothing specific to share at this point of time. A lot of things are happening. I think as we go ahead, I think the one that we had to discuss was basically our MOU with Cathay Taiwan, where I think the intent will be both to give an access to Indian investors to invest in Taiwan and vice versa, give an opportunity for Taiwanese investors to come into India. A lot of things are happening. So I think rather than sharing at this point of time, I think we'll share the moment I think it is closed.
All right. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good evening, and thank you for taking my question. I've joined a little late, so maybe this is a repeat. But I see that there's a very big drop in yields. Now, can you explain that? Is it because of very high churn in equity and the legacy assets, or is there a mix change within the equity only that we've gone to sort of larger schemes as a result of which that has happened, or maybe some of the other asset classes? Has there been any sort of major change over there to explain it?
No, so Madhukar, I had mentioned in my comment earlier as well, that Actually, the yields, can be attributed towards the 5 factors. One is, of course, the change in the asset mix. We have seen, higher growth in terms of ETFs versus the equity, and also, within the asset class, also how the product mix is behaving, especially on the fixed income side. How the, in terms of the overall investment growth has been coming predominantly on the ultra short term and the low duration kind of fund where our realizations lower. Further, the increase in size, whether it is MTM or with new flows, also lead to decline in the, realization. Further, there is a part of the churn, as you rightly mentioned, that, the older assets getting replaced with the higher assets because the old assets were with a lower trail and higher fixed, but the new assets are being replaced at a full trail model. So yes, of course. So these are the combination of factors, which has resulted in a decline, a marginal decline in the yield. But compared to the last quarter, we still, or even on YOY basis, we are marginally lower or almost flattish, at 45 basis point.
Yeah, well, but sir, if I look at it, your equity proportion in this quarter has actually increased, right? And while ETFs have increased in share, that's largely from liquid. So again, sort of they are compensatory. Maybe you could probably do a little bit more analysis on this and get back to us. That'll be more helpful. Second, on the HNI segment, sir, maybe you can elaborate a little bit more because the share over there still sort of lags. And what are we doing? And what is sort of the timeline that we see where we can, how we can improve our market share again over there?
Thanks for your question. This is Ashwin here. So first things first, may not, as Sandeep also mentioned in his earlier comment, that in the HNI segment, market share today is about 5.3% versus our organization's market share at 7.3%. So our first objective, obviously, is to try and build and take it closer to that number. But the nature of business is such that you may not be able to assign an exact timeline. And there are many efforts. So one, of course, is that in the last 1.5 years, we have seen a large number of HNI and family office participation in the ETF business. And there, our share in the HNI AUM of, ETF is 18% versus the industry percentage of 2%. Now, as the performance, on the equity side, continues to improve. If you look at our flagship equity schemes last 1 year, most of the schemes are in quartile 1 and quartile 2. And again, as the nature of the businesses, that the impact in terms of flows will be seen sequentially, with a lag. So we already are seeing uptick in market share over the last 3 to 4 months in the HNI category already. But we will really dwell on it once we see more linear increase in share. On the other hand, we are, with the support of now performance of these schemes and on the fixed income also, we're seeing robust flows. Our empanelment with large wealth counters and private banks, that is again work in progress. So we have seen some success, and we are seeing regular empanelment of those schemes with these banks. So it's a two-pronged strategy: direct interface with large family offices, and through these large channels, reach out to the HNI fraternity in general.
Right. And what does it take in terms of do you need to add manpower? What else what do these efforts sort of require in terms of resources? Do we have that, or maybe looking to add more people? How are we going to do this? So yeah.
Madhukar, I think we have all the elements. I think it's just a question of execution, and the initial numbers the smell check tells us, I think we're moving in the right direction.
Okay. All right. That's it from me. All the best.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Viraj from Securities Investment Management. Please go ahead.
Yeah, thanks for the opportunity. I just had one question. On the surplus cash, so if you look at the annual report, we also talked about last year, there's a lot of uncertainty and we were not really looking for any acquisitions. But given the environment now, is there any rethink in terms of, use of surplus cash?
No, so Sandeep in his con call speech also has mentioned that, we remain committed to both organic growth and also keep evaluating the inorganic opportunity which will come by. But what we believe is that growing this business organically is much cheaper. So unless we get something which is, at reasonably priced or synergistically add to our, values and ethos, that is only where we look at acquisition. But having said that, we are open for any kind of inorganic growth opportunity which come by.
And Viraj, I think it's not only going to be in the mutual fund space. I think for us, as we've been highlighting, I think our long-term approach is to be a true asset management company. We will also continue looking at opportunities in asset management, which could be non-mutual fund space also.
Sure, but even if you consider potentially for those inorganic opportunities, the cash will keep on building up. I mean, currently we pay somewhere between 60 to 90% in terms of payout. So is there any thought process in terms of increasing the payout or, probably giving a one-time special dividend, because cash at the books is having a suboptimal usage, just a thought.
No. So, Viraj, see, we are completely mindful of that, and therefore, if you see, we are sharing 85% of our profit year-on-year basis, as dividend. 2,700 crores have been paid out in the last, 7 years. So I think we'll continue to do so. As regards, the balance amount on our cash, as Sandeep mentioned, that we'll keep evaluating, the various options. And at the same time, we'll keep paying higher dividend. At this point of time, obviously this is the board as well as shareholders' prerogative to give any kind of one-time dividend. But I think having a good amount of net worth and keep the dry powder ready for any opportunity, I think it's a better strategy at this point of time. So I would say to a certain extent, we'll keep, this amount, available with us in cash.
Thank you very much and good luck.
Thank you.
Thank you. The next question is from the line of Mohit Surana from CLSA. Please go ahead.
Sir, I just wanted to understand two things. First is if there is any one-offs in the other income part, because I think it's risen close to 10-11% quarter on quarter. So is there any one-offs in the other income?
No, so Mohit, see, almost 80% of our investment is in our own mutual fund scheme, which is into fixed income, equity and ETF. We have been, reducing our exposure to equity, and that's every quarter. So this predominantly, is part of our equity assets as well as the ETF mark to market. We have had, this thing. There is no one-off. Of the total 100% of our cash availability, almost 80+% in our own mutual fund scheme, almost 12% all on FDs, and I think 3 or 4% in our tax-free bonds, etc. All of them are fairly liquid and are mark to market on a daily basis, and for our accounting purposes on a monthly basis. So there are no one-off. It is just the MTM impact as per the Ind AS.
Okay, got it. And sir, you mentioned that you can assume maybe a flattish trajectory on maybe OPEX going forward. So if you want to break it up between staff costs and other OPEX, staff costs, I understand that a large part of your ESOP has been expensed out in prior 2 years. So, but it has risen quarter on quarter. So was there maybe a hike in employee salaries this quarter? which has resulted in higher staff cost? And also, I just wanted to understand the fall in other OPEX from last quarter.
Yeah. So see, from an year-on basis, there is a 2% increase, 2% decline on the contrary, and from the which is because of the attributed towards the ESOP as you mentioned. But on a quarter-on-quarter basis also, if you see there is a 7% increase, which is of course is part of because we have a cycle of increments and bonuses of April to March, and that is a reflection of that increments which have been provided to the employees.
Okay, and if you can just comment on the other expenses part, do you expect it to remain flattish from here on?
So see, we have been mentioning there are two parts to the expenses. One is the fixed expenses, or the semi-fixed expenses, which are more operating in nature. We are working hard, to keep bringing it down. Then there are 2 or 3 set of other expenses which we mentioned, which is to keep ourselves future ready, which is in terms of any kind of technology for the IT purposes. On the digital side, to keep ourselves, cutting edge, in terms of our acquisition strategy on the digital space. And the third is the marketing space. Obviously from our brand building perspective, etc. So these are the 3 areas, where it is not a linear expenses. So, based on the market cycle, based on our fund launches and based on the traction and fund performance, we'll keep looking at these expenses. And as and when, these expenses are incurred, which will be accounted, but they are not going to be, coming into one quarter, together, and also they are not going to be significantly, higher. So I think you have to build in some 10 to 20% kind of, expense towards these kind of elements on a quarter basis, which may come in 1 or 2 quarters, but predominantly the fixed expenses part will remain in this range.
Got it, sir. Thank you. This is all from me.
Thank you very much. That was the last question in queue. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.
Thank you.
Thank you.